Hi there, I'm Mike Coe, and I'm addressing your open interest. If you have a question or a comment you would like me to address it, please send me a tweet at Michael_Coe, and I'll try to answer it. Okay, so we have a question here, and we've seen this question more than once from Mike Lee. At Options Action, I want to ask about the act of buying a long-dated in-the-money call and then selling weekly out-of-the-money calls as a way to generate income. Is it a better alternative than being long a stock? Okay, so this is an excellent question. This is sometimes referred to as a poor man's buy right or a synthetic buy right. The idea being that the long-dated in-the-money call option is a proxy for being long stock, and then, of course, just selling calls against it is why it's similar to a buy right or selling covered calls. But there are some differences, and let's take a look at some of those. Okay, so what are the advantages of using long-dated in-the-money calls as a proxy for stock against which you can sell some options to collect premium? Well, for one thing, long-dated options will decay less rapidly than shorter-dated options will, all else equal. So that's a potential advantage. In-the-money options can be used instead of at-the-money or slightly out-of-the-money longer-dated options because they have lower break-evens where they become profitable. So they have two advantages in this respect. In-the-money options not only are going to have a lower upside break-even because the strike is lower, but as you go in the money, the extrinsic premium on the option, so that's how much you're paying in excess of its intrinsic value at the time that you put the trade will be lower. So the absolute amount of potential decay is reduced. And of course, by using call options rather than the stock, if there's something catastrophic that takes place, generally speaking, you're going to see that you have lower downside risk. So if you have, for example, a 10% in the money call option and the stock falls by 50%, your losses will be considerably lower than those would be if you happen to also simply just own the stock. Okay. On the con side, though, there is a little bit of an issue here. So what are some of those issues? One thing is that you're going to generally pay a higher implied volatility than the implied volatility that you're selling. There are exceptions to this, of course. So if you're going into a catalyst, such as earnings, that usually elevates short-dated options premiums. But in general, what you're going to see is that upside calls will tend to trade at a lower implied volatility than downside puts will. So most options traders are reasonably familiar with this concept. There's another thing, too, which is that there's often an upward sloping term structure. So longer dated options may trade at a higher implied volatility than shorter dated options will, except in those cases that I just discussed, for example, going into an earnings event or similar catalyst that elevated those short-dated premiums. Another problem is that in-the-money options have less convexity. And what do I mean by that? So one of the reasons people like to own options in the first place is that you can, for example, in the case of a call option, you can have a very asymmetric payoff. The upside reward that you could potentially get if the stock or underlying asset rallies may be considerably higher than the downside risk that you face. And we refer to that as convexity sometimes. And if you have a really deep in the money call option, it will tend to behave a lot more like stock. So if the stock goes up $1, your in the money call option may rise by almost as much. But of course, if it falls, at least instantaneously, it may also fall by a similar amount. And then there's another final point, which is, is it suited to a core holding? Okay, and what I mean by this is, let's say you have a stock that you want to hold forever. By way of example, I happen to know that my mother has held shares of Kimberly-Clark for a long time. One of the things she likes is that they send a care package of their products, their paper goods, each year right around Christmas time. But if you're going to hold an underlying position for, 5 years, 10 years, or in the case of my mother's Kimberly-Clark holding, decades, it isn't necessarily so much better for you to own those long-dated calls, because if the stock pays a dividend, you won't be receiving them. There are potential tax implications, so there is some trade management. If it does pay a high dividend and the extrinsic value of that option decays, it might actually be advantageous to exercise it early. That's something you would need to monitor. So I would say there are cases where using in-the-money call diagonals in the way you suggest does make some sense. But if it is something that you're planning on making a core holding, something that you would hold for a very long time, if it's a stock that pays a big dividend, or alternatively, if it's a stock that you think does have some material downside risk, then you might want a little bit more of convexity in your positions. I think it's less well suited to that. So that's maybe not a definitive answer, but I hope it gives you some ideas of the things that you want to think about before you implement a strategy like that on the stocks that you may be looking at. I'm Mike Khouw. If you have a question or a comment, you'd like me to address it, please send me a tweet at Michael_Khouw, and I'll try to answer your questions as well. Thanks for watching, and please consider subscribing if you like this kind of content. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/open interest. And of course, you can also follow or tweet me at Michael_Khouw, or go to our website, www.openinterest.pro. Thanks for watching.